Every year, right around New Year's, the crypto market enters a strange phase. Volumes drop, price action turns choppy, and traders start asking the same question again and again. Is this the calm before a rally, or the start of another dump? To answer that, we need to zoom out and look at how crypto has historically behaved around the New Year transition, and what that means for investors heading into the next cycle. Crypto markets do show seasonal patterns, especially during the end-of-year holiday period. One of the most talked about effects is the so-called Santa Claus rally, a term borrowed from traditional markets. In crypto, this usually refers to the last 5 trading days of December and the first 2 trading days of January. Between 2014 and 2023, the overall crypto market cap rose in 8 out of 10 years during this window. Returns ranged from small gains under 1% to explosive moves of nearly 12%. Bitcoin, however, was less consistent. It posted gains in only 5 out of those 10 years, reminding us that altcoins often drive holiday optimism more than BTC itself. So while the Santa Claus rally exists, it's not guaranteed, and it's far from uniform. Looking year by year helps explain why. In 2016 and 2020, Bitcoin surged strongly during the New Year period, both during broader bull cycles with rising liquidity. In contrast, 2017 and 2021 saw sharp pullbacks despite strong prior momentum. In those years, the market was overheated, and the New Year became a release valve rather than a launch pad. The key takeaway here is simple. New Year rallies depend far more on the cycle than the calendar. Another important detail is liquidity. Holiday periods consistently see 30 to 50% lower trading volume. Institutions are offline. Market makers reduce exposure. Order books thin out. That creates a dangerous mix. Low liquidity plus high leverage. Small orders can cause outsized moves. Whales can push price easily. And liquidations often drive volatility more than real demand. That's why we often see 2 to 7% swings during this period, with no clear trend. Now let's talk about December as a whole, not just the final week. Historically, December has actually been strong for Bitcoin. Average December returns sit around 9.5%, outperforming many other months. But here's the catch. Those gains usually happen earlier in the month. By the time Christmas arrives, markets often stall, retrace, or go sideways, especially after strong November rallies. This makes the final week of December one of the least reliable periods for active trading. Fast forward to 2024 and 2025, and the pattern becomes even clearer. Bitcoin spent late 2025 stuck in a range, roughly between $87,000 and $90,000. Ethereum hovered near $3,400 to $3,500. Altcoins bled slowly, with some losing over 30% from local highs. Sentiment indexes flashed extreme fear, even as stock markets remained neutral. Why? Because this wasn't just seasonal weakness. It was liquidity exhaustion. ETF outflows increased, macro uncertainty returned, and the market entered what many traders called a holiday range trap. Social sentiment reflected this perfectly. On platforms like X, traders described the market as dull, frustrating, and directionless. Memecoin hype faded. DeFi narratives stalled. Even strong trends like tokenization and AI paused. But historically, this kind of boredom often marks the end of selling pressure, not the beginning. This brings us to the most important question. What usually happens after New Year's? In many past cycles, January acts as a reset. Institutions return, capital reallocates, risk appetite slowly rebuilds. That doesn't mean price instantly explodes, but it often means volatility returns with direction. Historically, periods of extreme fear during late December have preceded 20 to 50% rebounds in the following months. Not every time, but often enough to matter. So what should investors actually do during this period? First, avoid overtrading. Thin liquidity makes false breakouts common and stop losses unreliable. Second, use this time to reassess portfolios, trim low-conviction positions, strengthen security, plan allocations for the year ahead. Third, watch liquidity, not headlines. Most New Year moves are driven by positioning, options expiry, and leverage, not fundamentals. And finally, prepare, don't predict. The market rarely rewards those who guess the exact New Year candle. It rewards those positioned correctly after the noise clears. The New Year period doesn't decide the entire cycle, but it does reveal something important. It shows whether the market is exhausted or simply resting. And more often than not, the quiet weeks between Christmas and January are where the smartest preparation happens, not the biggest trades. Crypto has matured, but it still follows human behavior: fear, relief, greed, and patience. New Year's isn't a signal, it's a mirror. And what it reflects depends entirely on where we are in the cycle. Follow our Crypto Talk for more crypto alpha. See you in the next one.